Well, it was a quieter week in the financial markets last week as traders enjoyed the last of the summer break. Equities moving sideways, the dollar continuing to rally, and bonds gaining just a little bit as well, led by the long end of the Treasury curve. That comes after what was a little bit of a damp squib at the Jackson Hole Symposium, in all honesty, with very little in the way of forward guidance being issued by any of the major G10 central bank speakers at the annual symposium. It's a holiday-shortened week here in the UK this week, and the calendar highlights all focus on the United States, with GDP, PCE, and of course the latest US labour market report due as the week draws to a close. Plenty as always for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's get into the show. Well, there's a busy show ahead, so let's bring Ryan in straight away. Ryan Littlestone from Forex Flow Live and Forex Analytics. Good morning to you, mate. How are you doing? Enjoy the long weekend, did you?
Yes, mate. Bit of a busy one. Had some family down, so feel like I've been running Ironman races all weekend, paddling rivers, swimming in oceans, and all the rest of it.
Crikey, what on earth have you been up to? Ironman races, blimey. Lucky for me to do the ironing, let alone an Ironman race these days.
I can see that by the state of your shirt.
Oh, wow. That is a low blow for 8:10 on a Tuesday morning. That is uncalled for.
You set that one up, mate.
I really did. We'll be going for the hairline next, but I
see, there we go.
Really...
1-1.
Right, before Ryan and I knock 7 bells out of each other, let's get on to topical thunder. Well, plenty to discuss, as I mentioned this week. I want to start with the Jackson Hole Symposium, and I'm going to have a bit of a rant, to be honest with you. I think I made this point last week. I'm not sure whether it was in the show or whether it was when we were chatting beforehand, but can we just put an end now to all this fanfare that surrounds Jackson Hole? Every year we come up to kind of mid-August and we're all going, and I'm as guilty of it as anyone else, and we're all going, oh, Jackson Hole, it's going to be important, it's going to be amazing, it's really, really important, and then there's never any fireworks. I mean, when was the last time that Jackson Hole was actually important and impactful? I mean, we're probably talking pre-COVID at this point. And to be honest, I think we should just be treating it as any other central bank speech. We hear from the G10 central bank governors and presidents on a 3-weekly or monthly basis these days anyway. And to be honest, I'm not really sure we learn anything of particular interest or value from the shindig last week. I mean, to be honest, it just seems like a good excuse for everyone who's got anything to do with G10 central banking to get an all expenses paid holiday in Wyoming during some pretty nice weather. So if I had a plane ticket and was over there on holiday, I might have a different view, but sadly I don't. So the inner cynic comes out of me. In terms of the actual speeches, I mean, Jay Powell just stuck to the script, really. It was pretty much a copy and paste from what he said at the July Fed press conference, leaving the door open to further tightening, still in data-dependent mode. Higher for longer is still the core message. We kind of knew all of that already, and it wasn't wrapped up in anything more hawkish or, for that matter, anything more dovish than we've heard before. Christine Lagarde, the ECB president, I don't really know why she bothered, to be honest, because she really didn't say anything. I think there were probably about 3 or 4 Bloomberg headlines that actually came out of her remarks on Friday night. So pretty glad I didn't hang around to watch those. Again, the message from the ECB remains the same. They're data dependent. They're going to take a meeting by meeting approach. The market is still at a roughly 40% chance that the ECB hike in September. But I think no matter what Lagarde says, this week's CPI data, which comes out on the 31st, which is Thursday morning, that is by far and away the most important determinant of whether the ECB hike or not later on, early next month, I should say. And then, of course, we heard from the Bank of Japan Governor Ueda as well. Again, not really much of any interest here, kind of dovish, stressing that there's still low inflation in Japan, not really signaling any sort of a policy shift anytime soon. And another central bank governor who just didn't deviate from the script that they've laid out in the last 3 or 4 months. So, Ryan, am I being too cynical here, mate, or was Jackson Hole just a complete waste of time?
Yeah, these events are funny because it always has the opportunity to surprise us with something that we haven't heard before, or a headline that sends markets moving. But I think it all depends on what markets are doing going into these events. You know, if the markets are getting to extreme dovish levels for some reason on one economy or one central bank or another, we're seeing big moves in the market where perhaps they're not quite justified. That's when you might get one of these central bankers popping up and adding a few extra lines to their speeches and just to come out and say, hey, you know, we're sticking to this plan, that plan, the other plan. So markets at the moment, you know, don't need to be doing what they're doing. But going into this one, markets were pretty well set on where they feel central banks are. You know, a bit of tinkering around over the data that we got last week regarding expectations. But yeah, you know, you've got to wonder why they do these events. Is it just for them lot? Because it certainly doesn't seem to be much for the market. So you know, someone's got to be getting something out of it. Like you say, a couple of all expenses paid trips over to the US for their summer holidays. You know, pop over to Disneyland on the way back.
Absolutely. I mean, for once, actually, I'm going to give him some credit. Andrew Bailey, Bank of England governor. Well done. Skip the whole thing. Nothing to say, no point turning up, don't spend taxpayers' money. Well done. It's probably the only good thing he's done in the last 18 months or so, but, you know, credit where it's due, I suppose.
Didn't he send Broadbent over instead?
He did, yeah, but, you know, deputy governor, so hopefully he was in, you know, sort of premium economy rather than the first class that Andrew Bailey.
Class, yeah.
Yeah, absolutely. We mentioned that data last week. Why don't we dig into that? Because, I mean, certainly the PMIs out of Europe and the UK were, well, grim, let's be honest.
Yeah, grim is one way to describe them. And we were speaking last week going into the week of all those PMIs. Were we going to see a bit of a turnaround or were we going to see the hole getting deeper, if you like? And that's what it did. That hole very much got deeper. Now, after last week's PMIs, pretty much every country now has both services and manufacturing in contraction territory. Germany and the UK both had a stinker with steep drops in their services numbers deep into the negative. And the US is just about keeping its nose above the 50 number expansion water, put it that way. Now, we know that the PMIs aren't everything, but they are the earliest data of the month and they do move markets, as we saw. And they are showing a definitive slowdown in activity. And that's getting the market more and more on edge about future rate hikes. However, we're not out the woods with inflation. And if it wasn't for that still remaining sticky, I think we would already be in the race to cut rates. That trade is going to be coming. So if inflation does continue to fall and we see economies faltering further, we'll be getting properly into pricing rate cuts next year, irrespective of what the central bankers tell us. Now, I think maybe Q4 this year and into Q1 next year will be the time when that trade becomes clearer. But if inflation is closer to central bank targets, but economies are not improving, then the race to cut will be well and truly on. And it'll be the currency with the lesser amount of problems with the economy that will be the one that sort of keeps its gains and where the market's going to gravitate to. So there's going to be a lot coming up over the next few months once we finally have this summer break, and then I think we're going to get into it in earnest.
I agree, and that currency is you've left us on a cliffhanger there, right? It's like the ending of EastEnders or something. Go on, what currency is it?
We don't know yet. That's the whole problem. You know, it's a race, and we haven't started yet. All the runners are lining up. You know, it could be the US, it could be Europe, it could be the UK, it could be Japan lagging behind. You know, it doesn't matter. We're almost going to be playing a reverse of what we played over the last 18 months, 2 years. You know, who was going to hike the most, who was going to hike fastest, whose economy was doing well. We're going to be doing that in reverse. So once we finally, the market is still buying into the higher for longer. But as I say, if inflation remains sticky, that keeps the markets on the hawkish side, irrespective of what economies are going to be doing. But if inflation continues to come down, but we continue to see further weakness, then we're definitely going to be playing the rate cut trade. But okay, I'll throw it back to you. Who do you think is going to be keep their head above the water, shall we say, in terms of currencies?
Well, I was going to say that fence you're sitting on is not big enough for two of us. So I am going to come down with a view this week. There is very, very little doubt in my mind that it'll be the US and it'll be the US dollar. You know, you look at even the situation at the moment. The US is I've seen it described as the cleanest dirty shirt. It's really the only economy where, it is keeping its head above water, particularly in the services sector. Only just, but I would caution that with the US, we also get not just the S&P global surveys, which we referenced there, but we also get the ISM surveys, which are a little bit more widely watched. Yes, they've got a kind of narrower pool of respondents. They focus much more on larger firms, but they are a little bit more resilient, particularly in terms of services, than we've seen in the S&P global surveys. But if you look elsewhere, I mean, let's just kind of take a trip eastwards across the globe. The UK, we've already seen signs that consumer spending is softening. I know we addressed that last week with the retail sales number. It was blamed on the weather, but when you get another poor print in August, are we going to blame that on the weather as well? I mean, there's only so much we can blame the rain for at this point. And the PMIs we got last week were not great, not only in terms of the headline metrics, which were contraction across the board, particularly in services, but also the leading indicators, new orders and things like that were pretty grim. Europe is really struggling, as we know. Germany is in a world of trouble. It's quite amusing, actually, that Germany suddenly is being described as the sick man of Europe, which, funnily enough, when they were describing us as that, they had no trouble with the description. When everyone describes them as it, all of a sudden their central bank governor is up in arms trying to free themselves of that nickname, which, to be honest, is earned, because the economy is really struggling there, and that's dragging the rest of the Eurozone along with it. And of course, one of the big issues with Europe is what's going on in China. And China, as we know, as we can try and work out from the incoming data, is also facing very stiff headwinds. The recovery there seems to have lost pretty much all momentum. And the stimulus that's being delivered is, one, falling short of market expectations, and two, is kind of pushing on a string at this point. So, when you look at what's going on elsewhere, I find it tough to bet against the US, and particularly tough to bet against the US consumer at this point.
Yeah, very much so. I mean, one of the reasons I haven't given my tip at what currency could potentially do better or worse is because that's coming up in one of my other topics. So I don't want to give any spoilers out.
Oh, there we go. Leaving us on edge. Go on, everyone, stay tuned for the next 5 minutes, and that one will be revealed. But first, you've got to listen to me ramble on about Friday's US labour market report. Of course, Friday being the 1st of September, the first of the month, which means it is, of course, time for the latest US jobs data. This time last month, I think I was sitting here going, actually, the July payrolls print doesn't really matter too much. That's not the case with the August data. I think this is of much more importance than the figures we got for July, because it's the last jobs report that we get before the September FOMC decision. Before we get into the report itself, just to give a bit of context around the timing of the report, this weekend coming is a long weekend in the United States. It is Labor Day on Monday. As a result of that, it's not uncommon at all for a lot of people to take the Friday off. If you're not taking the Friday off, you're probably going to be wanting to leave your desk very, very quickly in order to get away and enjoy your long weekend. So as a result of that, we may see a kind of burst of activity after the jobs number drops, and then things could quieten down again pretty quickly. On the other hand, if we get a big deviation from consensus, which I'll lay out in a second, then we could see more volatility than usual, because the market is likely to be a little bit thinner, bearing in mind you're going to have fewer market participants trading around the number because of the Labor Day holiday that we've got coming up on the Monday. So just bear that in mind if you are brave enough or foolish enough, depending on your view, to trade the payrolls print on Friday lunchtime. In terms of the expectations, headline payrolls, according to the Bloomberg consensus this morning, a few estimates are still to filter in, are set to have risen by around 170,000 on the month. That's just a rounding error away from the pace of 187,000 that we saw in the month of July. Unemployment should stay at 3.5%, which is very, very close to cycle lows, and earnings is expected to cool ever so slightly to 0.3% on a monthly basis from 0.4% prior. All of that, if we come out in line with expectations or as close to those expectations as you can get, would be pretty solid, to be honest, especially if we see participation remaining close to the 62.6% highs that we've seen for a couple of months now. But in terms of looking forward and in terms of the implications of the job report, I think there's the key question is a strong report going to be enough to force the Fed into a September hike? I would say no. The flip side of that is a weak jobs report enough to flip the Fed into a decidedly more dovish stance at the September meeting, say that the tightening cycle is done. Again, I would say no. I think the key thing with the jobs number is not only look at the August report, look at the September report. If that is again strong, and if that again shows what importantly real earnings growth on a yearly basis, then very quickly you're looking at a November hike becoming a lot more likely than the 40% chance markets currently give it. And perhaps that could be where the next leg of dollar upside comes from. So in terms of payrolls this week, I think it's again going to speak to the resilience of the labour market in the face of what's now 18 months worth of tightening. But in terms of its immediate policy implications, I don't think, no matter what the number, is going to make a material change to what the Fed do at the September meeting.
Yeah, very much so. I think we're still in that situation where everyone's waiting for the one that turns the jobs market around, the negative print or unemployment shooting up. But I think if, anywhere over 100,000, even if it's the low 100,000s, is okay. It keeps jobs moving along as long as we get nothing significant changes in the unemployment rate, participation rate, wages, as you say, then the market's going to tick along. The only thing I would say is, we got a couple of big prints a few months ago, and it's just edging lower in these prints. We're now sub 200 and staying sub 200. So that might just start be indicating a bit of slowing going on. But this is the NFP. It can easily come out another 400,000 and surprise everyone to the upside. So that's why we love this number. It was the most anticipated number when I worked on the live floor. It's absolutely packed up, shoulder to shoulder.
The war.
Yeah. And then
during the floor, really, but
Yeah, exactly. And 5 seconds before the number popped out, deathly silence, and the buzzer would go, the number would pop up, and pandemonium. And half hour later, everyone was back in the pub. But I think if we do get a softer number, obviously we're playing this game where we're messing around with hikes. I don't understand why some in the market are saying, a September hike might be off, we're pushing it to October, November. Either they need to hike now, or the conditions are there to hike now, or they're not. If you're not going to hike now, what's going to change October, November to cause a hike then? So if we get this jobless number coming in, I think you need to pay attention to those wages numbers. Because they have, again, proved a little bit sticky. They're up around the still 4 to 5% mark, which now, with inflation coming down, it's moving wages into real positive terms. And that's something the Fed will keep an eye on. They don't want to see a wage spiral. They don't want to see wages getting too hot and adding inflation back into the pipe where it's already been coming down. So it's going to be a fun day either way it happens. If we do get a big negative miss, then it's going to be fireworks.
Yes, indeed. A couple of things, actually, just to round off this little segment on payrolls. One is, we have come off the 3, 4, 500,000 that we were printing on a monthly basis. But you think back to before COVID, and you just said, I know we were late cycle in 2018, 2019, but 170, 180 was probably the average pace over a kind of 3-6 month period. If you had a 2 handle on the front of it, you'd say that's a pretty good number. So I think it's important to view it in that context. The other thing is, in terms of population growth, I think I read the other week that you need 110-ish on a monthly basis just to keep up with population growth. So anything above that is a bonus. And very lastly, I've just called up on the screen here while you were talking the Fed's June economic projections, because of course the September meeting will get an update on these. The Fed at the June meeting were saying unemployment is going to rise to 4.1% by the end of this year. Now, if we're sat here talking about 3.5% unemployment in August, you've got to have a catastrophe hit that jobs market to get near the 4.1% call that they've written down for the end of the year. So at the September meeting, wouldn't at all be surprised if we saw a pretty chunky downward revision to that unemployment call, which in itself would have hawkish implications, you'd expect.
Yeah, very much so. But it's important when we watch the numbers dropping is you keep an eye on that participation rate. That gives you an indication of what's happening with unemployment. The perfect storm is the unemployment rate going down, but the participation rate going up. But the reverse is the same as well. If unemployment goes up, and the participation rate goes down, that's a sort of double negative as well. So you have to cut all these numbers up, read them in the context with other numbers that affect them. But 4.1%, we're at 3.5. So it's only a couple of pips each month until the end of the year. And they can get there.
They can get there, but what's that? 2 or 3 million jobs you've got to lose at that point, I would imagine.
Yeah, maybe.
Maybe slightly under 2.
Yeah, it could happen. It would be a stretch, obviously, to see that happen. And if it does, then the proverbial is probably going to be hitting the fan. But you can never rule anything out with this jobs number.
No, that's very true. If it does, we're certainly not going to be sat here talking about how many more times they're going to hike and how long they're going to hold at terminal. That's a given. Anyway, let's move on. I think we've done the labour market to death there, and we're certainly going to chat about it again next week after the number anyway, aren't we? So let's move on.
Yeah, and going to give a bit of trading insight in this segment here, and talking about when it's right to be wrong in a trade. Chances are that most traders will be wrong more than they are right. If that wasn't the case, we wouldn't have such large percentages of traders who don't make money, unfortunately. But there are times when it's wrong to be wrong and times when it's okay to be wrong. The times that it's right to be wrong is when you are wrong on your terms. That means when you are wrong because you don't have a plan, or you didn't follow the plan, or didn't have a plan to be wrong, you need to change things and how you do things. So when I plan a trade, whether it's an off-the-cuff headline trade or a quick scalp or a longer-term trade, the very first thing I do is plan to be wrong. That wrong will be my stop loss, i.e. the amount I'm prepared to lose on a trade. Now, if I have that planned, there's no surprises. There's no, the market has moved against me, what should I do now? Like a deer in the headlights. If I'm wrong, I'll lose money, but I'll be ready to lose that money. And that wrong trade won't be enough to damage my account. If I've planned for as best as possible what happens if I'm wrong, then everything else should be right and profits should take care of themselves. So from that point, you can move on to maximising the profits with the right trades, which should vastly outweigh the losses from the wrong trades. That's why I only have around a 51% win rate, because I make more on the trades I get right than I lose on the ones I get wrong. If you're going to get a trade wrong, learn how to be wrong in the right way with correct risk management and correct planning, and then those wrong trades won't hit you too hard on your account.
Yeah, absolutely. Like you say, and we've spoken about it at length on the show before, is priority number one is protect your account. The biggest risk any trader is facing is risk of ruin. And that is always the risk that you should be managing. And, like you say, it is not uncommon for traders to have win rates of, 50, maybe even 40, 35%. But the way it's working is, and how they are still profitable, is they're cutting their losses quickly. They know when they're wrong, they're not hanging around, they're getting out of that trade, they're moving on to the next one. And their winners are 2, 3, 4, 5 times bigger than their losing trades. And that is how you end up, one, slowly but surely building an account over time, and two, more importantly, staying in the game and knowing and protecting that capital and avoiding that risk of ruin that we mentioned. So I think it's very, very important, any trade you're taking, have a plan, have a level where you're going to be wrong and stick to that level. I think the worst thing you can do is plan something out meticulously. I don't know, let's say, for example, long cable below 125, I'm wrong. We get to 124.90 and you go, actually, no, I think it's going to bounce. So 124.5, I'll be wrong there. And before you know it, we're at 122 and you're still in the trade and you're now 3 big figures underwater, or 3.5 big figures underwater. So yeah, very, very sage advice as always, Ryan.
Yeah, thank you. And you're right. That's what I think does the most damage to trades. They let trades get away from them and do exactly as you say. Okay, it's gone against me. It must turn around soon, and so I'm going to stay in the trade. And then, like you say, you dig yourself a deeper hole, and it's hard to get out of. And you've had a triple the loss you were going to have in the first place. So planning is always the key to trading.
Absolutely. And, let's be honest, no one likes to be wrong. No one likes to admit that they're wrong. But in this business, if you're going to make a success of it, you've got to get used to it, because if you can't be prepared to admit when you're wrong, you're very, very quickly going to end up losing your account in this game.
Yeah, you've got to admit to yourself. You've got to know when you're wrong and admit it. You know, there's no pride in trading. Pride doesn't make you money. Sensible head does.
Absolutely. And on that note, let's move on to that's the setup. Momentarily forgot the name of a segment on my own show there. That's a sign that I haven't had enough coffee this morning. Right, let's get into the charts. I want to start with the dollar index this week, revisiting last week's play of the day, actually. The dollar continuing to move to the upside. We have pulled back a little bit over the last day and a half or so. We ended yesterday in the red just about, although it did amuse me, and I know you saw this morning, Ryan. I got a Bloomberg alert on my phone on the way in this morning saying the dollar enters correction territory. What? I mean, we're down for like a day and a half. This is just stupidity at this point. In any case, last week we closed north of the 104 handle, and we had a little test, a little kiss of the 104.50 mark that I flagged as the extension target to the upside as Jay Powell spoke on Friday. We couldn't quite break above it, so I guess the question is, what comes next? Well, 104.5 is now resistance to the upside. Of course, that will still be the level that the bulls are targeting a break of. And then to the downside, you still have this nice ascending trend line in place, which comes in around 103.5. And then you've got the 200-day moving average, which is going to be very, very strong support below that. And actually, that comes in pretty much at the 103 figure, which, of course, is making that a very strong level as well. So personally, given that we've got the payrolls number coming out this week, given that the US economy remains, as we said a moment ago, the cleanest dirty shirt in the laundry that is the global macro economy, as long as we're above the 200-day moving average, I'm pretty happy to be bullish on the buck and buying any dips that we might see.
Yeah, well, it's been quite strange because this has been really grinding high over the last few weeks, which if you look at some of the ranges that we've got in a lot of the pairs, we are in old places. You know, look at euro dollar, we're still around 108, at the odd move to 109, not really pressuring the downside an awful lot in moves under 108. The same with cable. Yeah, we've broken 126, but we're back above that this morning, and that keeps everything in range. So there's really only been a few drivers. Dollar yen, obviously, one of the big drivers there, and the yen in general, further weakness there. Then we've obviously had the moves in dollar one that we've spoken about before. Commodity currencies have been getting hit hard. You know, dollar CAD's been running higher. We've had Aussie, Kiwi, both of them down at big key levels. So it's not all a one-way move in this dollar, which is why it's difficult to look at the dollar index and think it's it's wholesale dollar strength. There are some anomalies about with that. But what's going to be interesting, I think, with this one, again, just coming out this summer period, are we going to see when markets get back to fuller trading, these moves continuing, or are people going to come back and go, oh, hang on, that's a bit higher than where I left it, so I'm going to start getting in some shorts. So where we go in the next couple of weeks, I think, is going to be the important factor.
Definitely. I think London time, probably about 12:30 on the 5th of September is when we might get half an idea on that one, when New York come back after their Labour Day weekend and take a proper look at the charts, as you say, probably for the first time in 4 or 5 weeks. I think you're doing a little bit of a revisit of your play of the day as well this week, aren't you, mate?
Yeah, well, if it's good enough for you, it's good enough for me. So I'm going to take a look back at my play of the day, Kiwi from last week. Going to take that trip down memory lane like you have. My trade last week was to buy the Kiwi into the 61.8 fib of the October 2022 move up, but that was around the big figure 0.59. That one worked out well enough. We saw a bounce to 59.80s before the pullback. We are back down at the level, and what's worrying now is we've had a couple of breaks under the big figure, but we've held that March-May trend line that you can see marked on the chart there. I'm still in some of my long trade, doing my usual slicing and dicing as the price went my way. But what's not encouraging is the lack of a proper bounce since we came back down here. Some of it may be these summer markets, and it was pretty quiet around the Jackson Hole stuff. So I'm still running stop reverses just below the trend line. I'm keeping them the same size as my original long trade, so a bit larger, than what my current remaining longs are. Because I think if we do get a break and we can't bounce back above that 60 handle soon, we're going to be heading low. And I want to try and catch that break if it happens. So I'll be looking to offload a bit more of the long positions, any opportunity above 59.50s, but I'm getting a bit worried that we might be on for a break lower.
Yeah, I think the Kiwi's starting to look rather sorry for itself at this point, isn't it? As you said, those bounces, those rebounds that we've seen, as you can see on the chart there, have been very, very short-lived and sold into pretty rapidly as well. This is obviously a 4-hour chart. So yeah, I would certainly be looking for this to continue moving lower. I mean, obviously that fits with my broader view on the dollar. And of course, the other thing you've got to bear in mind is the RBNZ. They are pretty much done in terms of their tightening cycle. They've telegraphed that very, very clearly indeed. So the Kiwi is not going to find any particular impetus or bullish impetus from that side of things. And of course, you've got China, which is applying a little bit of downward pressure on this as well. So I certainly, this doesn't scream buy to me at the moment. And I think your strategy there is a very prudent one, mate.
Well, let's hope so. I mean, you know what they say, a level is a level until it's not. So I'm still happy to sit in the longs, but like we just said in the prior segments, I'm going to be planning to be wrong and see if I can make money being wrong.
Absolutely. Right. I want to talk about cable. Cable's at an interesting level because I think we're almost, or when I pulled this chart yesterday, we're about 20 pips higher now. I think we're almost exactly where we were when I originally sat here and went, cable's overvalued. The BOE are never going to get to 5%. Let's sell the hell out of it. We'll get back down to 120. When I made that call in, what was it? I think March time, as you can see, it was hopelessly wrong. But in any case, the dollar remains pretty much king of the hill when it comes to G10FX. And of course, sterling is not immune to the continued run higher that we're seeing in the dollar. An interesting move last week in the pound because we broke below the 100-day moving average, which is the green line that you can see on the chart there. And actually, that's the first time we've broken below that level since early mid-March of this year. And before then, we were below it quite consistently for much of autumn 2022, of course, when we had the shenanigans going on with Liz Truss and all the rest of it. Of course, we had rallies being capped by the 50-day moving average. We then broke lower, and it looks like rallies are now going to be capped by the 100-day moving average. So selling into any rallies into that level is my preferred strategy here over the short-ish term. I'd be looking for a test of and perhaps even a break of the 125 handle. But I think sterling still has very little going for it, particularly after the data we got last week. I don't really see the BOE doing much more, if anything more, after the September meeting. So, if we get any rallies here in cable, then I'll be first in queue to sell into them.
Oh, you're always so bearish, the quid, mate. One of those perma bears that we often hear about. But yeah, this was
sorry, perma bears when I've been bullish risk all year.
Well, yeah, bullish risk, but bearish the pound. So you can work out what you are with that one, Mr. Teddy Bear. We've had this move down, and around the low 126s to the big figure has been a significant level, and we've broken that. Whether we hold this break or not remains to be seen. As I say, we're back above 126. What I'll be looking at for a real bearish turn is getting below that 126 and holding it. If we find that a solid resistance, then potentially we are going to see further downside, and you might be getting that 125 level that you've got on your chart there. There's certainly some decent fibs in action as well. We got the 50 fib of the move from March that comes in 124.72, so pretty close to that 125 big figure. The pound was the darling of the FX world when economies first started spluttering. It couldn't seem to go down for love nor money, but potentially we're getting the turn here, and I've got a couple of reasons why when we move on to my play of the day.
Well, I was going to say, not only your play of the day, but of course you're going to talk about euro sterling first as well, aren't you? So why don't we let you crack on with that?
Yeah, the crack on with that indeed, and. I got that completely wrong. It's not my play of the day. It's got nothing to do with the pound. It is this one. So,
I'll help you out, mate. Don't worry.
Yeah, okay, as long as you've got me pointing in the right direction, that's all that matters. But euro sterling, and there's definitely more work to be done in this one. This is a trade that was pretty long in the making. I spoke about it on previous shows going back a few months, and that was looking for that 85 handle, move to that big 85 level for longs, and that's one that gave a good opportunity to grab a bounce in that one. It's given a second opportunity last week with another move back down there. Now, this move last week was a clear indicator of what data means when trading. We broke through the big figure last week, particularly when Germany services the PMI, collapsed. That sent us through the big figure there, not for any length of time. Moved down to sort of the 90s. Then we had a little bounce, and then we pretty much reversed that and bounced pretty hard when the UK did exactly the same thing with its services number. So there's plenty of two-way action going on in this pair. And this one, I think, is going to be a perfect example of what trading the potential rate cut race will look like when trying to work out which economy will falter worse. This is why I couldn't give a proper example to Michael, trying to put me on the spot as to what currency will be the best one. Because I think, whatever economy suffers the worst, that's going to impact the central bank, which one will cut first. Now, I think that the Bank of England remains one of the banks, countries, UK, at most at risk for current rates hitting the economy harder than others. And for this pair, hitting the economy harder than what happens in the Eurozone. And obviously then what happens to the ECB. This is why I still favour the long side in this one, because if the UK gets hit harder because our rates are much higher and intending to still go higher, then I think the economic impact for those are going to catch up very quickly to the UK. That's going to see the pound suffer. That's going to see this pair move into the upside as money moves out of sterling, perhaps into the euro. However, I don't think we've seen the last of this 85 level just yet. So a bit like the Kiwi trade, I'm happy to play longs into the level down 85. If we get another quick move down there, though, I'll be less inclined to. And I'm still keeping my sell stops active below 84.80 in that blue zone at the bottom, because if we do break through there, I think it might have some legs and we get a bit of a violent reaction further down.
Yeah, it's a difficult one, this, because I normally sort of come out in a rash if I end up being bullish on the euro. But in this case, I actually agree with you. I think what is interesting to me is everyone seems to have either forgotten about or is willfully trying to ignore this issue of remortgaging that we've still got to deal with here in the UK. We're already seeing, as we said, consumer spending soften. Activity more broadly in the services sector is rolling over quite significantly. And then as we move into the autumn, you've got people doubling or tripling their mortgage rates from 1.5% to 6% or wherever the average 2-year fix is now. I think it might be slightly below that level. And that is going to hit disposable incomes. It is going to hit consumer spending pretty hard. And I think when you see that start to come through in the data, the BOE are going to try and back away from this relatively hawkish stance pretty quickly. I mean, they're still not actually that hawkish when you think about it. They're still giving us a tightening bias, which is contingent on inflation remaining persistent. It's not just an outright, we're going to keep raising rates type of thing. So yes, I do tend to agree with you here. And I think euro sterling upside could well be on the cards, as much as it pains me to be saying that.
Yeah, definitely. And yeah, you're absolutely right. Again, this is one of those ones where you're going to be watching the data. We know the UK is high, maybe got one more hike in the pipe. But if inflation remains sticky here and they're forced to go even higher than, 5.5, 5.75%, it really is going to be lighting the fuse for when the economy really does tip over, because it's really going to hit at some point, and it will hit harder here than it will in the US or the Eurozone. And that's when everyone's going to get out the pound.
Well, exactly. Well, on that incredibly optimistic note, why don't we move on to our plays of the day? Right, I want to talk about the Swiss franc this week. Normally, if I was going to play the Swissy, I'd be doing it against the euro. But I don't really want to have too much to do with the euro at the moment, particularly as this is a bit of a longer run idea or theme, and especially with the CPI numbers out of the Eurozone due on Thursday morning, and with all of the uncertainty that brings around what the ECB do in September, trying to throw the euro into this equation will just complicate matters. So what am I doing this week? I want to be long dollar Swiss this week. I think the building blocks are starting to pile up a little bit for a pivot from the Swiss National Bank in September. They're one of few G10 central banks, perhaps the only one that's managed to get inflation considerably back below their 2% target. And they've done this while they're still purchasing the Swiss franc, which doesn't make particularly much sense, given that they have now pretty much achieved their mandate. So I would not at all be surprised to see them adopt a much more dovish stance at the next meeting, which comes on the 21st of September, and also amend their language around their FX intervention, which could also apply some upward pressure to the pair. Of course, combining that with the broader bullish dollar view that I have. A couple of other things in the mix as well. Of course, growth in Switzerland remains very, very ropey. It is an incredibly small and incredibly open economy that is almost entirely dependent on the Eurozone, and we know exactly what's going on there. And of course, as the chart shows, really the market is not really using the Swissy as any sort of a haven at the moment. So I'm looking to position for dollar Swiss upside here using the 87.50 lows that have solidified themselves throughout July and August as a stop, and ultimately looking for a break north of that 100-day moving average and a move back towards the 90 handle in time for the next Swiss National Bank meeting. Ryan, you're also looking at havens this week with dollar yen, aren't you?
Yeah, dollar yen is my play of the day this week, looking to run pretty much with a 146.50 break. The yen is getting back to being spanked again. We got a decent slap back from the first test around 146.50 all the way down to under 145. But the bounce so far has been pretty impressive. A lot of the market has put a big fat intervention target on 150. But it's important to know what the yen is doing across the board, and it's weakening in many pairs, some to higher levels, in the crosses than where we were when the Ministry of Finance intervened last time. So there's no denying that the risk of intervention may grow, but we're not there yet in terms of jawboning levels or language from various officials. So this pair still has a bit of a green light if it wants to go higher. So I will be looking for a long on a break of this 146.50, 60 area, but with a confirmation hold. So that means that it goes through and then we come back down and we see that level holding. That, to me, will kickstart another leg higher. And if we move up to those crosshairs at 150 with no language change from the Ministry of Finance or the Bank of Japan, there's going to be a good chance of a possible break of that 150, clear out all those intervention front runners that may be lining up, and we get a decent push higher.
Indeed. Good stuff. Well, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and if there's anything you want us to pick up on and discuss next week. We will, of course, be back again this time next week, and we look forward to seeing you then. So thank you very much for watching, and goodbye for now.